In today's episode of the MSA Rental Market Update, we are looking at the Spartanburg rental market for conventional multifamily properties. As you can see, CoStar has the Spartanburg, South Carolina metro statistical area drawn out on the map here and where it is in relation to Charlotte, Greensboro, North Carolina. There is the Raleigh-Durham market, Fayetteville. Here's Columbia, South Carolina, Augusta, Georgia, Atlanta, Georgia, and Knoxville, Tennessee is up here. So it gives you an idea of where this market is in relation to other markets. And so what are we excluding? We are excluding all corporate, all military, all senior, and all vacation. And we are only including market and market affordable so that we are only looking at conventional multifamily properties. If I go to location, you can see we are in market, metro statistical area, Spartanburg, South Carolina. So let's go take a look at the analytics and see what the analytics tell us about all three asset classes combined. So here is the supply side snapshot for the Spartanburg metro statistical area. There are only 166 properties in this tertiary market, totaling 14,648 units. So very close to the size of Lake Charles, Louisiana that we looked at yesterday. There are 1,208 units under construction, and in the last 12 months, 534 more units rented than went vacant, and in the previous 12 months, 1,508 more units were rented than went vacant. Our vacancy has increased. We've gone from 9.8% in this market to doggone near 15% at 14.9%. That is a big vacancy number. Not as big as yesterday, but it is trending that direction, it looks like. We still show a year-over-year rent increase. If you remember yesterday, we had a year-over-year decline in rent. Here we have an increase of 5.1%. We'll see what it looks like quarter over quarter. We do not look at the capital market. We only look at the space market. And if I scroll down and look at the long-term occupancy average, we can see this market likes to sit right about 90.5%, and it is currently all the way down to almost 85%. So about a 5.5% spread between where it is and that long-term occupancy average. So at the end of this, we will plot and see where it's going to fall on the market cycle chart. We know it is well below this long-term occupancy average, so more than likely it's going to be somewhere either within recession or, as with Lake Charles, maybe it's transitioning back up to recovery. Could we have two markets in a row? I don't know. Time will tell. I've not looked at this market. So let's go take a look at the data and see what the data shows us for all three asset classes combined. So here is the rent analytic data for the Spartanburg metro statistical area. We do not look at asking rent. We don't care what owners are asking. We only care what they are collecting. First quarter of 2022, it was at 1140, went up to 1155, up to 1169, up to 1175. I do believe that this is the first market we have seen 4 straight quarters of rent increase for all three asset classes. We've seen it in the Class Cs quite a bit, but we have not seen it in all 4 asset classes. So that is very interesting considering we're sitting at 85% occupancy. That makes no sense. So let's see if we can't dig into the numbers a little bit and see if we can figure out why. We do have deliveries entering the market, 628 units delivered in the first quarter and only 235 absorbed, only about a third. Not good. Then no delivered and 182 more units were rented in the second quarter. Then 728 delivered, only 161 absorbed. So that occupancy, although it ticked up in the second quarter, is now trending back downwards again. 328 more delivered in the fourth quarter and only 40 absorbed, taking that occupancy all the way down to 86%. Folks, I don't know about you, but 86% occupancy, I'm starting to lower some doggone rents to try and get some people in these units because our NOIs are darn sure suffering because of this vacancy. So very shocked that we are seeing continued rental increase with these rentals. So let's see if there is a specific asset class. My guess is the Class Cs are what's driving that up. I have not looked at the individual asset class data, so I don't know for sure. But my guess is that the Class Cs are pulling this market up or those rents up. But let's see what the A's tell us first. Then we'll go look at the B's and then the C's. Here is our Class C rent analytic data. There are 15 properties in this market totaling 2,700 units. Looking at effective rent, we started at $12.89 in the first quarter, went up to $13.23, went up to $13.43, and then down to $13.38. So we had a break in the Class A's where we didn't in the overall. So from the third quarter to the fourth quarter, we had a decrease in rents. Let's scroll over and see what deliveries and absorption tell us. We had 208 deliver in the first quarter, only 45 absorbed. No deliveries in the second quarter, 127 absorbed. That ticked our occupancy all the way up to 92%. 318 delivered, only 166 absorbed, so about half. And occupancy went down to 87.2. 64 deliver, then 107 absorb, so good absorption, so occupancy ticked up. So we're sitting right around that 90% mark, 89% occupancy, still well below where it should be. Well, actually 1% below where it should be, according to the long-term occupancy average. So we can see demand-supply fundamentals working, where we went all the way down to 87.2. The rents were lowered going into the fourth quarter, and that increased our occupancy up again. So this may be an inflection point here for the A's. Not really sure. We'll have to see how this continues to trend. So that's the story the A's are telling us. Let's go see what the B's are telling us. Here's our Class B rent analytic data. There are 65 properties in the market totaling 8,390 units. Looking at effective rent, we started at $11.46 in the first quarter, went up to $11.60, up to $11.75, up to $11.85. Very interesting. So we had an increase in rents in all four quarters. Once again, I don't believe we have seen that in Class B in any of the markets. Let's look at deliveries and absorption. 420 deliver in the first quarter, only 225 absorb, so we tick down in occupancy. Then no deliveries and 64 absorb, so we go up in occupancy. 410 deliver, only 28 absorb, and we go down in occupancy. 264 deliver, only 55 absorb, and down in occupancy again. So the fact that we have this downward trend says that we should have definitely, especially when we're sitting here at 84.3% occupancy, there is no reason for those rents to continue to climb. It's interesting that we are absorbing units. Typically, when you see the occupancies this low, the absorption goes the other direction. So a little anomaly here that we are having some absorption with this much vacancy in the marketplace. So that is the Class B, once again, not following the demand-supply fundamentals and kind of doing its own thing, which just means that the ownership is using unethical practices and just raising rents because they can believe they raise rents. At 15% vacancy, you should not be raising rents. Okay? So let's go see what the Class C market is telling us. Here is our Class C rent analytic data. There are 70 properties in the market totaling 3,242 units. Looking at effective rent, we were at $9.53 in the first quarter, and look at this, a small break. You can actually say it's probably stabilized kind of right around this $955 mark right here, and it even only goes up to $956 or $960. So $953 to $950 to $956 to $960. So a little bit of a stabilized number here. You can see in the price per foot, we're 105, 105, 105, 106. So we had that little tick up in this fourth quarter. Very interesting considering we are still at 12.3% vacancy, that we get a tick up of anything at all, which again makes no sense. But let's see what absorption tells us, because we should not have deliveries. And as I suspected, we have negative absorption. Now, very interesting that the A's and B's were absorbing and the C's were not. So could have a tale of two stories here. One story, it could be saying that the C's are upgrading to the B's. which is why we had absorption in the Bs, even though we had 15% vacancy. You don't go from Cs to As. So the other story it could be saying is that these renters in this marketplace, because this is a tertiary market, it is in the deep south of South Carolina, up in the foothills, kind of real close to the base of the Appalachian Mountains, that they just can't afford these rents and they are doubling up or roommating up. Okay, that could very well be the case. The fact of the matter is these rents should not be increasing. They should be declining, but we are still seeing them increase in this market, which is showing unethical practices by the ownership here. This is going to come to a breaking point. What could this mean for other investors is NOIs are obviously dropping in this market. The numbers are telling us that. As your vacancy continues to increase, that means you are losing rents in those other units. That little bit of rent growth that you have is not going to make up for units going vacant. Your NOI drops below that. If that drops below that long-term or drops below your debt service coverage ratio requirement by the lender can call the loan due. So there may be some trouble coming in this market from what I'm seeing, but all I'm doing is trying to interpret the numbers into a story. We have a few different stories we can tell, okay? So what does this mean for the Spartanburg metro statistical area on the market cycle chart? Well, we know it is well below this long-term occupancy average. We definitely have properties under construction and deliveries yet to come. And we had some rent growth. Actually, we had rent growth in all three asset classes. The only break we saw was the fourth quarter for the Class A's. And we saw a very small break in the second quarter for the Class C's, but then grew in the third and fourth. So we have rent growth, but I believe that it is not growing due to fundamental principles, because when you are this far below the long-term occupancy average, you should be lowering your rents, not increasing your rents. So I'm going to place the market right here in recession on this point because of where the vacancy is in the market, even though we're showing some rent growth. Again, I believe it's arbitrary. I don't think it's from demand-supply fundamentals with that much vacancy in the market. So this concludes the Spartanburg, South Carolina metro statistical area. Stay tuned for tomorrow when we take a look at Birmingham, Alabama to finish our week out. We'll see you tomorrow.